So now that securities are issued, that's how the primary market works. How does the secondary market work? Well, if an investor wants to buy or sell a security from another investor, there's four broad categories. There's the direct search type of market, and on that one, buyers and sellers just sort of seek each other out informally. A good example of that might be a garage sale. Not very financial. But a fairly good illustration of how this process works. There's no real standardized goods being traded, but there are buyers and sellers, and it's just sort of up to them to find each other. That means because there's not really any standardization, there's no real reason for anybody to get involved in this, and that's why buyers and sellers are just sort of left on their own. The next step up in organization, though, does begin to actually exhibit some structure, and that's a brokered market. So if what is being bought and sold is standardized sufficiently for a specialized amount of knowledge to develop, then there might be somebody who becomes that specialist, and they find it worthwhile enough to acquire the specialist knowledge of these securities, find buyers, match them up with sellers, and in other words, help the market work a bit more smoothly than if buyers were just left to fend for themselves, as were the sellers. So a good example of this might be real estate. Of course, there's literally real estate brokers. Their information or their value, the reason that they earn their commission, is precisely because they make it their job to be specialists in the valuation of houses. They are the ones that try to match up buyers with sellers, and they try to guide the transaction the way that you would not if you had a direct search market. Now, of course, remember, there is a direct search equivalent to real estate. Sometimes somebody will list their house as for sale by owner. In that case, that'll be a direct search type of market that person would prefer to participate in, I guess because they think that the broker in the real estate market might not have sufficient specialized knowledge to really justify the fees that they would earn in commission. But many other types of goods are sold through brokered markets also. Now, moving closer to financial markets, a dealer market is one in which there's a lot of trading activity, and the thing being traded is fairly standardized. So a good example of that might be a bond. And there's actually a strong reason for an intermediary to emerge and actually justify whatever fees they earn by the value that they add. A dealer can help a market function more smoothly if they build up an inventory of bonds and then sell it to buyers. In other words, they sort of act like a market maker. If somebody wants to buy, they will buy from them. If somebody wants to sell, they will sell to them. And if there's enough trading going on in the market that they can reasonably be assured of finding somebody to buy and sell to, then they'll undertake to do this. And of course, the compensation that they earn from that is the bid-ask spread. They will buy for a lower price, they will sell at a higher price, and that's how this dealer intermediary actually profits and therefore earns the return that they want in exchange for participating in this market as a middle person. And finally, an auction market is one where there's complete standardization. There's one place for everybody to go. Everybody knows to go there if they want to trade this particular security. So that would be any type of exchange. Now, historically, there have been exchanges for all sorts of things. There have been grain exchanges, other commodity exchanges, but of course now there's the most common type of exchange is perhaps a stock exchange. But in all cases, these really work like an auction market. A certain number of people show up and they want to buy. Another certain number of people show up and they want to sell. And again, they set their price based on supply and demand, the amount of whatever good there is to be sold versus the amount of it to be demanded. But here too, there is going to be a bid and an ask. Let's talk about these. What are bid and ask prices? Well, a bid is an offer to buy, and an ask is an offer to sell. Now, why are these different? Well, this essentially goes to this idea that in order for a market intermediary to really want to get involved, there has to be some sort of fee that they can collect. And the difference between the price at which they're willing to buy versus the price at which they're willing to sell is this fee. So in a dealer market, the bid is the price at which the dealer is willing to buy from you. Let's say you want to sell a bond. A dealer will quote you a price of, I don't know, let's say $102. And at the same time, if another person comes to this dealer and they want to buy a bond, well, the dealer will sell to them for a different price, and usually a higher one. So maybe they will sell to them for $104. And that, of course, means that what the dealer has pocketed in the transaction is the difference between the bid and the ask, or $2. That's the fee that they collect. And this extends to exchanges as well. It's just that in that case, it's the exchange that collects the difference between the bid and the ask. Investors will always sell to the bid, and they will buy at the ask. And that difference goes toward, it's sort of like the fee collected, or at least one of the fees collected by the market intermediaries for making the market work. So you can think of the bid-ask spread as the profit or the fee collected for making a market in a certain security. Now, the last thing that I want to talk to you about is what types of orders there are there. We know what there is to buy, what financial assets there are. We know how you might think of buying them. In other words, what allocation strategies and selection decisions you might make, whether you want to pursue a passive or an active investment strategy, whom you will buy them from or sell them to, what type of market you'll participate in. So finally, what sort of orders will you place to actually get the transaction done in the market? Well, the first type of order is a market order. What that does is it's an order that's executed immediately, and the person submitting it receives whatever the current market price is. So you will say, I want to buy right now, whatever the price is right now. I want to sell right now, whatever the price is right now. So you get timeliness. The order is executed right away, but you don't really get any discretion on price. You take whatever price there is. Now, in contrast to that, you could have a price contingent order, which is to say you can have something like a limit order where you actually specify what price you're willing to take, whether to buy or to sell. So you can essentially view time and money as sort of trade-offs. As the common saying goes, time is money. Well, in this case, they actually sort of are, because you can choose one or the other. If you want a quick transaction, you submit a market order. If you want discretion over the price, you submit a limit order, but then there's no guarantee that the order will be filled quickly or at all. Because let's say you want to say that I will buy a certain stock for $100, and it's currently trading at 99. But over the course of the day, or sorry, you want to sell it for $100, but right now it's at 99. Well, if it goes to 100, then of course your order will be executed. What if it doesn't? What if it goes to 98? Then your order will actually never be executed. So not only will it not be very timely, it in fact won't be timely at all. So to make a long story short, you can either choose quick execution with a market order, or you can choose the price at which you get execution with a price contingent order, the most common of which is a limit order. And maybe the other thing to think about is the size of the order. So you've got time to execution, price, but also the number of securities bought or sold. And generally, the bigger the order, probably the more variability there will be in prices, mostly because, well, prices change. And if you want to buy a lot of a security, you're going to push the price up. So let's say you submit an order to buy 1,000 shares, and this is a market in which maybe each day only a couple thousand get traded overall. Well, you're half the market. So that means that your first share might be executed. Let's say you submit a market order for 1,000 shares. Your first will be executed at whatever the current price is. But by the time you get to the 500th or the 1,000th, the price will actually have gone up. Because remember, if prices are set at the nexus of supply and demand, you, being literally half of the market, have now drastically shifted out demand. Supply probably hasn't changed. So that means that you've gone from whatever the price used to be to whatever the price now is at this new intersection of supply-demand, which is substantially higher. Analogously, if you submit an order to sell, well, if you're again half of the daily volume, the first share that goes through will probably be executed at whatever the current price is. But now you've drastically changed the supply. You've shifted supply out, and that means that the price at which the security trades will now drop. So by the time you get to the last parts of your order, because it's unlikely you'll find one buyer who's willing to be the other half of the market for you. You'll probably get it allocated across multiple buyers. Well, by the time you get to the last few shares for the last few potential buyers, you're going to be pretty far down on the demand curve because of how far you've shifted out the supply curve. So large orders get filled at multiple and usually increasingly unfavorable prices. Small orders generally get filled at whatever the current market price is. So hopefully this has been helpful. Again, this is sort of intended to be a broad overview of how the markets work in terms of regulation, structure, what we mean by things that you can actually buy in a market for financial assets, and what those financial assets are and why you may choose to buy them, as well as what they entitle you to. And now we'll actually in subsequent lectures, move on to analyzing these financial assets using more quantitative than these qualitative approaches. Thanks for listening.